Welcome back to the deep dive. Okay, today we're tackling something pretty big. It sits right where your own finances meet. Global stability, we're talking about trust in the US dollar, where our national debt is heading, and, those shifts happening under the surface in the global economy. So let's unpack this. Our deep dive today is digging into a really interesting bulletin from Gold IRA Company's bulletin. It's called Dollar Trust Fades Amid Debt and Market Warnings. Our mission, simple. Pull out the most important stuff from this report, give you a shortcut to understanding all these complex bits: the economy, markets, geopolitics. We're looking at the data, the facts, and what it really means for you.
Yeah, and it's a critical topic. The report really highlights how, complex and maybe risky the global landscape is getting. What's fascinating here is how central trust is for a reserve currency. And the dollar's position is being challenged. A lot of different factors are involved. We'll be covering specific things, the actual debt numbers, some market signals, and those bigger geopolitical shifts that are playing a role.
Absolutely. And we're starting with a number that's, it's kind of mind-blowing, frankly, the U.S. national debt. So the bulletin puts it at roughly $37 trillion. That's as of August 2025. Now, for listeners who track this stuff, the speed, that's what's really striking. Over $10 trillion added in just 5 years. That breaks down to more than $5 billion every single day. It can feel a bit abstract, these huge numbers, but the report puts it in perspective. It's about $108,000 of debt for every American citizen and per household, something like $279,000. Maybe the biggest point here, the debt is now more than the country's GDP, about 119% of GDP. That's a high we haven't seen since after World War II. Historically, that's a real sign of fiscal stress.
Right. And we connect this to the bigger picture. These aren't just numbers on a page. They signal real systemic imbalances in our finances. The report points to a few key reasons for this climb. Big federal budget deficits are a major one, driven by rising costs for programs like Social Security, Medicaid. That's ongoing. Then you've got the interest payments on the debt we already have. They're climbing fast, eating up more of the budget. And the bulletin also mentions recent fiscal policies, stimulus, infrastructure spending, things like that. They've added obligations without, matching revenue increases. So this combination widens the structural deficit. It kind of locks in higher debt for the future. The key insight, I think, is how this slowly chips away at the perception of America's long-term economic management. It affects everything: business investment, how countries manage their currency reserves. It's like a slow leaking confidence, not a sudden break. And the consequences, they're real. It can crowd out private investment, sure, but it also ties the government's hands in future crises. And it can make borrowing more expensive for everyone. Ultimately, it makes you question market confidence, whether investors will keep lending to us on good terms long term.
That point about the slow leak, the subtle erosion of confidence, that's really insightful. It's not always obvious damage, right? And those real economic effects, like the bulletin says, they're starting to show up. We're seeing cracks in the financial markets. The report flags a few warning signs we should look at. First, consumer stress. Things like subprime auto loan delinquencies, people struggling to pay their car loans, are at record highs, higher even than during the 2008 financial crisis. That's not just one small thing. It shows real financial stress for households, especially those relying on credit for basics like getting to work. It signals a wider vulnerability. And then credit markets are flashing warnings too. Lending spreads are extremely narrow. What does that mean? Well, the profit margin for lending is tiny, pushing lenders towards riskier loans to get a better return. That can hide problems building up in the system. It's often an early warning sign.
Exactly. And if you link these specific warnings to the broader market, the report shows a risky level of concentration in the stock market. Just 7 big tech companies make up nearly a third of the S&P 500's total value. That's a record concentration. Kind of reminds you of past bubbles like the dot-com era, where so much depended on just a few big names. If those few companies hit trouble, the whole market feels it. And valuation metrics like price-to-book ratios, basically, how much people pay for a stock versus its book value, they're also at historic highs. That makes the market more vulnerable to a sharp drop. Plus, you've got the rise of passive investing. Lots of money follows indexes, buying what's already gone up, sometimes ignoring fundamental value. It creates a bit of an echo chamber. This raises a big question, on how stable the financial system really is underneath, especially when you see that a key safety net, the Fed's reverse repo facility, has shrunk dramatically. It's contracted by 97% in 2 years. That facility is a buffer for liquidity stress. With it so reduced, the system is less able to handle shocks. Banking reserves, credit conditions, they're more vulnerable to volatility now. So the system looks okay on the surface, maybe, but the shock absorbers aren't what they used to be.
That shrinking buffer. Yeah, that's a sobering thought. Less resilience just when we might need it. Okay, so these internal pressures, debt, market risks, they're huge. But this deep dive shows it gets even more complicated when you look globally. The bulletin talks about trade policies, like tariffs being a kind of hidden tax on American consumers. For example, tariffs on imports may be meant to help local industries, end up making things like electronics or clothes more expensive. That cost often gets passed to you, the consumer, hitting purchasing power and adding to inflation. And beyond trade, the report goes into the tricky effects of international sanctions, specifically the ones related to Russia. They haven't just hurt Russia. You could argue they've actually boosted support for the leadership there. And they've strained European economies needing Russian energy. But critically, freezing sovereign assets like Russia's reserves, that's shaken global trust in the financial system itself. Other countries are watching, wondering if their own assets are safe, if the system is truly impartial.
And what's really insightful there is how these things, the economic policies, the geopolitics, directly feed into the erosion of the dollar's status as the world's reserve currency. The dollar's power relies heavily on America's economic strength, yes, but also its political stability and the depth and reliability of its markets. So you take the massive debt we talked about, add geopolitical uncertainty, add protectionist trade moves, and that confidence gets strained. It's not like a switch flipping off. It's more gradual, people reassessing. And unlike past shifts, like when the dollar took over from the British pound, which took decades and world wars, there isn't one obvious replacement for the dollar right now. But diversification is happening. The report points this out clearly. Emerging market central banks are actively buying non-dollar assets, mostly gold, but also other currencies, exploring alternative payment systems. This isn't just adjusting portfolios, it's strategic. It's hedging against a weaker dollar, against risks in the current system, and trying to gain more monetary independence in this changing world order.
That's a really key point. A shift is happening, even without a single clear successor currency yet. So, okay, what does this mean for people looking for some stability in all this? This brings us to a really interesting part of the bulletin, the growing role of gold and precious metals. The trend is striking. Central banks around the world are buying gold much faster now, at rates unseen for decades, the report says. This isn't just one or two countries. It's widespread, a strategic shift. And there's a concrete example in the source, Bolivia. They needed cash, couldn't easily borrow dollars, so they used their local gold reserves to raise about $3 billion. That's not theory, that's practical. Using gold when traditional finance is tight. It shows gold's role as a fallback, universally accepted wealth.
Right. And it begs the question, why gold, why now? By these big players. The report goes back to gold's history. It's always been seen as a reliable store of value, especially during big economic changes or crises. Think about it. Unlike a government bond or money in the bank, gold doesn't depend on someone else's promise to pay or whether a government is solvent. It has intrinsic value. It's tangible. It's existed as wealth for thousands of years. So it becomes a kind of barometer for systemic stress. When trust in fiat currencies, like the dollar or the whole financial system wobbles, gold looks more attractive. These central bank purchases, they aren't random bets. They're described as prudent, long-term diversification. It's a clear signal they have less faith in the long-run stability of paper currencies and worry about interconnected risks globally. They're trying to shield their reserves. It's like acknowledging gold as a foundational asset again, especially when things feel so uncertain.
That difference gold's intrinsic value versus the counterparty risk of other assets. Yeah, that makes its appeal very clear right now. Wow, okay, it's a lot to take in. But let's bring it back to you, the listener. What are the bigger takeaways here, beyond the headlines? Our sources talk about this growing disconnect between economic narratives and underlying realities. The bulletin uses the word illusions, like debt being framed as just fuel for growth, not a burden, or market bubbles seen as sustainable, or downplaying defaults in some areas. The report warns these narratives hide real vulnerabilities, real threats to stability. It really highlights the need for a more honest conversation. It's not about fear-mongering, but about seeing the systemic risks that maybe aren't politically easy to talk about.
Exactly. And that reinforces the call for, a more sober approach. Policymaking grounded in fiscal reality. The report mentions broad agreement among experts, bipartisan agreement, actually, that we need long-term fiscal sustainability. That means tackling entitlement reform, Social Security, Medicaid. It means looking hard at spending across the board and getting revenues closer to matching our promises. Protecting financial markets is also key. That means good regulation, watching those credit spreads and market concentrations we discussed. And monetary policy that focuses on stability, not just short-term boosts. On the geopolitical side, the bulletin touches on how powerful interests, like the military-industrial complex, can sometimes complicate peace efforts. They might push policies that serve specific agendas over broader economic cooperation, which can increase tensions. So, Diplomacy needs to balance power realities with economic common sense, especially as the world gets more multipolar. Things like clarity, restraint, and real economic cooperation, they're vital to lower the temperature globally.
Okay, so wrapping up our deep dive. The core message from this Gold IRA company's bulletin seems really clear. You've got this mix: soaring debt, shaky financial markets, big geopolitical uncertainties, and yes, it's all undermining trust in the US dollar and, the stability of the whole global economic system. Understanding how these pieces fit together, complex as it is just crucial for everyone. The report really hammers home the need for responsible awareness, for informed discussion as we navigate this evolving landscape. It's not just theory, these are fundamental shifts.
And this leaves us with a pretty important question for you to think about building on all this.
Yeah.
How does this big global move towards diversification, especially central banks, buying gold signal something more fundamental than just, say, a temporary hedge against market swings? What could it mean long-term for how international trade works, for payment systems, and even for your own financial planning in a world where the dollar's dominance isn't the given anymore? Keep exploring these themes. Understanding these shifts really does empower you to navigate what comes next.